All right, welcome back to another edition of Financial Accounting. A couple quick announcements here. I have uploaded your grades earned to date for your first four homework assignments. So if you go to the My Grades area in Blackboard and you will see this screen, make sure that the points I have uploaded are the correct points. I take the percentage of the points you've earned on each homework assignment and multiply that by 2 points to determine your overall score for that homework assignment. Up towards the top, you see that we will keep track of a running total of how many points you've earned on homework assignments, and on exams. And then the running total overall is shown up above that. That corresponds, that amount of the number of points, the amount of points you've earned out of the denominator will determine the percentage of points that you have earned to date. That percentage corresponds to your grade. If you have any questions about that, feel free to refer back to the syllabus or give me a holler. Another thing I have emailed you guys about is the homework, Proctorio homework assignment. You want to, when you go in there, it's on the left-hand side, you will want to read the instructions carefully, follow the instructions very carefully before you begin the assignment. When you start it, your Proctorio monitoring will begin. This is an assignment that is like homework. You can stop it and go back into it, but realize one of the main purposes of this is to check to make sure that your computer is ready to take exams in this class. You need to have the Proctorio extension installed in your Google Chrome in order to make that work. One of the most common issues people have is having a password required when they start it. Just to be clear, no assignments or exams in this class require a password. If you are prompted for a password, you need to debug that. So go into the technical issues document and follow the guides here, or go into the Proctorio guides themselves, which are also here too. You need to make sure your computer is working properly for that. You're welcome to ask me for help on that, but at the end of the day, it's your responsibility. You can contact BACS or you can contact TTU Blackboard for more support. If you don't have a computer that works to take the exams, there's nothing I can do on my end. So make sure that you get this assignment done by next Tuesday to ensure that you are ready to take the exam next Friday. We need to jump into 2.3 and 2.4 because these are some critical parts of the chapter that you need to understand prior to taking the exam next week. So 2.3, we already talked about analyzing a transaction, determining what was given, what was received. We talked about how we keep track of both those things and how they affect the overall accounting system. When it comes to inputting the information from transactions into our accounting system, hopefully by now you realize that we work through a double entry accounting system. We record the dual effects of each transaction, what was received and what was given. We input that into our system so that way, at the very least, we have complete knowledge of the financial impact of each transaction on what was given and what was received. That helps to make sure that we make few mistakes. This is a system that's been around for about 6 centuries now. It seems to be working pretty well. So it's important that you understand the process of how we do this. Realize that when we're recording what was given and what was received, we're going to affect at least two accounts each transaction. Some accounts, some transactions require more accounts, but if you kind of go back and recall from the previous class, when we issued stock, we got cash. Cash would be an account. Common stock was an account. So we're going to have at least two accounts that we adjust for each transaction. One important thing that you need to understand right now is we are not going to record increases and decreases using pluses or minuses. We do not show changes using positives or negative amounts. We use debits and credits to record increases and decreases into certain accounts. Debit means left side, credit means right side. Left side, right side of what? Left side and right side of the accounts themselves. Each account is represented by a T. We call them T accounts because on the left side, we show all the debit entries. On the right side, we show all the credit entries. So T accounts, accounts go up and down. Does that mean we use the left side to record the decreases and the right side to record the increases? No, we do not. Debits don't mean plus or minus. Credits don't mean plus or minus. Whether or not a debit means increase or decrease depends on the type of account. If we're talking about an asset account, asset accounts, we show increases on the left-hand side. Therefore, debits increase asset accounts. Credits reflect the decreases. We want to show these things separately. We don't want to just blend them all into one column. It gets a little hairy. It gets a little crazy after a while. We create two columns, one to show the ups, one to show the downs. In assets, the increases, the ups, are the debits. That's on the left-hand side. For liabilities, the increases are on the right-hand side, as well as the increases for stockholders' equity. Think about this like a mirror image. Assets increase with debits, liabilities and equity increase with credits. We use debits and credits because it helps us keep track of account information and also make sure that our accounting equation balances every step along the way. Total debits have to equal total credits whenever we're recording transactions. These are just the rules. What will help you is to, for right now, try to remember not the rules overall, but try to at least remember how accounts increase. At least focus on that, because if you can remember that debits increase assets, then you know that credits decrease assets. It's got to go one way or the other. Credits increase liabilities and equity. Try to remember just that. That way, when you come across any decreases in liabilities, you know, oh, it's got to be the opposite. We need a debit. Again, these are just rules. You have to know these things. We're going to refer back to these all throughout the course. One thing to keep in mind with regard to stockholders' equity is the retained earnings account, and in particular, the different buckets we use to track changes in retained earnings, namely dividends and expenses and revenues. Generally speaking, stockholders' equity accounts increase with credits. Retained earnings, therefore, follow that rule. But we don't input revenues, expenses, and dividends directly into retained earnings. Retained earnings is the reservoir. We will keep track of revenues in their own separate buckets. We'll keep track of expenses in their own separate buckets and dividends. We then empty out those revenues, expenses, and dividends into retained earnings later. Dividends, we keep track of dividends as a reduction to overall equity. So dividends primarily are debited to reflect any type of reduction. Rarely do you use credits when you're dealing with dividends. Same thing with expenses. As we incur expenses, we're always going to be debiting the expense accounts. Rarely do we credit the expense accounts. When it comes to revenues, we almost always credit revenue accounts. Rarely do we debit those things. Revenues, expenses, think about it like this. Generally speaking, credits will increase stockholders' equity. Revenues, expenses, they don't appear on the balance sheet, so they may follow their own sort of rules. Revenues, expenses, think about those things as buckets. We primarily fill buckets, rarely empty them. Retained earnings is usually only updated once. Think about buckets for revenue, buckets. By buckets, I mean revenue accounts. Think about expenses, expense accounts as buckets, and dividends as their own buckets. You'll see this later when we talk about the closing process, but we keep track of the myriad, the thousands of revenue and expense transactions in separate buckets because these accounts help us produce the income statement and the statement of retained earnings. We don't want to just dump in thousands of transactions into retained earnings every time there is one. It's too much noise. So we keep track of revenues, expenses separately. So expenses, if you think about it, we're primarily just debiting expenses, rarely ever crediting them. Dividends, we primarily just debit those, rarely credit those. Revenues, primarily you see in revenue accounts credits, rarely do you see any debits. So they kind of act like these dummy accounts. They're just they're just buckets that we fill up and then empty out into retained earnings later. When we empty out these buckets, what you'll see is just the summary, not all the individual transactions. You'll just see a bulk line item for all the expenses, one bulk line item for all the dividends, one bulk line item for all of the revenues, and that determines the overall balance in retained earnings. Again, we will practice this more, but for right now, just realize that dividends, expenses, and revenues, they have their own buckets and they are equity accounts, but dividends and expenses tend to take on a bit of a different characteristic. There can be thousands of accounts that we use within the business, but generally speaking, they all can be sort of categorized as asset accounts, liability accounts, equity accounts, namely um, any type of common stock, retained earnings, revenue, expense, dividend accounts. We can call these accounts, even if there's thousands of them, we generally can categorize them as among these different categories here that you see on this page. We could have, for instance, 10 or 20 different cash accounts, but all those cash accounts are just asset accounts. So just keep in mind that to keep it straight, all these different accounts that we have in a business, we usually create a listing called a chart of accounts. And the chart of accounts will show all the different types of asset accounts, liability accounts, equity accounts, and whether or not they're typically increase with debits or credits. How do you see debits and credits play out? How do debits and credits affect the T accounts? Let's take a look at the transactions we explored from the last class. Recall from transaction one, we got cash by issuing stock. Assets increase. If an asset increases, the rule is that we must debit that specific asset account. If it's an equity account, the rule is we must if it's an equity account that increases, the rule is we must credit that equity account. They're just rules. I recommend writing them out someplace so they're easy to refer to when you're doing your homework. We saw this in the last class. Right now, I want to show you how we reflect these things how these different transactions are reflected in the individual accounts. We used pluses and minuses in the previous class. We're no longer going to do that. What we're going to do is transfer the information into the individual accounts themselves. Cash increased. That's what we saw up above. How do we show that increase in the cash account in debit credit formats? We go to the T account and we know because cash is an asset that debits, the left-hand side, are where we reflect any increases. So we will show a $50,000 amount on the left-hand side under cash because cash is an asset and $50,000 is an increase to that account. We don't show pluses or minuses anymore. Common stock increased. Go to the common stock account. Ask yourself, is common stock an asset, liability, or an equity account? Common stock is an equity account. Equity accounts increase with credits. You can see here the $50,000 isn't a plus or minus, it's just an amount. So when you take a step back and you kind of look at this, you kind of see there's sort of a scale here, right? So imagine we've got this, I'm kind of bad at drawing these things. Imagine you've got the scale. We need to make sure our total debits equal our total credits every time we record a transaction. Total debits must equal total credits. Take it a step further. Transaction number 2. We use some of our cash to acquire land. Right? What did we get? We got land. Land is an asset. That account has increased. Therefore, the rule says we need a debit to that account. Cash is an asset. It decreased. The rule says credit that account. So down below, what you see is instead of using minuses and pluses, we're going to say land increased. We need to debit land because land is an asset account assets increase with debits. Cash went down. Cash is an asset account, so credit we must credit that side of the T account. These things, these rules, they seem kind of crazy, but after a while, a pattern emerges. So you have to make sure that you're reading your book, taking notes as you go, and doing all the homework assignments. Eventually, this stuff will start to click. One thing to know, and we'll get into this into more detail later, we're not going to, whenever we come across a transaction, we don't immediately post it into the T accounts because these accounts tend to get kind of crazy and noisy after a while. Usually what we do to ensure that our debits are equaling our credits is we record a journal entry. And the journal entry starts first by listing what account is debited for how much, and then finally which account is credited for how much. Later, as a secondary part, we post or transcribe the information into the ledger. The ledger, also known as the books, is where we see all the individual accounts. And when we look inside any particular account, we will be able to see what changes happened during the period. Credit for decrease, 40,000. Other things to keep in mind, account balances. We are talking about T accounts here, and accounts in general have a balance. So we usually start off with a beginning balance. We record the changes, left side, right side, debits on the left, credits on the right. The net of those, when we take the debits and the credits, we net those together to figure out, do we have a net debit balance or a net credit balance? In asset accounts, because they increase with debits, we typically expect to see a normal debit balance. A normal debit balance means the sum of the debits is going to be greater than the sum of the credits. So in the case of cash, if we have this many in debits and this amount in credits, we net these together to determine, oh, there's an overall debit balance. Think about it like this. We start off with 0. We collected $1,000 in cash. We paid out $800 in cash. The net of these two is a net debit balance. Why? Because the left side has more debits than the right side. We follow that rule whenever we go through and post our journal entries to the ledger. If for whatever reason, cash being an asset, normally we see that the side of the T account that increases, that's the side where we expect to see some kind of balance. If though, for whatever reason, let's just say we collected $1,000 in cash, but for whatever reason, we see that we paid out, say $1,500 in cash, we would see in this case, the credits being more than the debits, we would have an abnormal balance in that account. The reason why we call it abnormal is because we don't expect to see a negative balance in these accounts. They're either positive balances or they are 0. So in this case, I'd be suspicious as to why we have an abnormal balance. Maybe we wrote a bad check. But the bottom line is, regardless of whatever the account is, make sure that you sum up the total amount on the left and sum up the total amount on the right and net those together to determine whether or not you get a debit balance or credit balance. Typically for assets, we see debit balances. For liabilities and equity, we see credit balances because we follow how those accounts increase to determine what their overall balance is going to be. Down below is an example, assets, cash being one of them. If we sum up all these debits and we net them against all these credits, we will see that we have a net debit balance. That's normal. That's what we expect to see. For liabilities, we see accounts payable account. The net of 3,700 against 1,900 results in a normal credit balance. If for whatever reason, and I've done this before, maybe once or twice in my life, if for whatever reason I had a debit balance, an abnormal debit balance for my liabilities, that would suggest that I overpaid on an amount that I owed. Therefore, an abnormal balance is good to see. have stand out like a sore thumb, so I know I need to take some sort of corrective action. But if the accounts have their typical balances, debit or credit, then generally speaking, it means I've done things correctly. Just going to keep in mind that some of the problems I might give you. Generally, what I do is I give you sufficient information to figure out an answer to a question. So the number one way to help keep information straight in your head is to sketch things out on scratch paper. If I tell you there's a beginning balance in a liability account that is $900, it's a normal balance, you need to know what that means in terms of a T account. Liabilities have a normal credit balance, so a normal $900 beginning balance starts up at the top. This is where we put all the beginning numbers up at the top. Then we work our way down. During the month, utilities payable was debited 200, credited 300. So plug those numbers in and then figure out from there what is the ending balance in that account. It seems pretty straightforward, but realize it takes some practice. On this side, we see that we have a total credits sum up to all of our credits sum up to $1,200. All of our debits sum up to $200. When you net the 1,200 with the 200, what do you get? A credit balance of 1,000. What's the ending balance? $1,000. Is that a balance a normal balance or an abnormal balance? It is a normal balance because why? Because one, this is a liability account. Liability accounts typically have a credit balance. Liability accounts have a typical credit balance because credits increase liabilities. In this particular case, we should expect to see a credit balance. If we do, that means it's normal. Everything is fine. Here's another example. Let's assume that cash, you're given information that cash has a normal balance, beginning balance of 100. During the month, $200 was received in cash, $400 was paid in cash. The question comes down to, what is the ending balance in cash? How do you determine that? You sum up all the debits, 300. You net them against the credits, 400. You have more credits than debits, therefore you have a net credit balance of 100. Now the question comes down to, well, that's the amount, that's the balance. Is that 100 normal or abnormal? Here's what you need to remember. Assets increase with debit. Therefore, assets have a normal debit balance. We expect to see a debit balance. Do we in this case? Based on how we drew this T account out, this is an abnormal balance because it shows up on the right-hand side. It's $100 is the balance, but it is abnormal. In this particular case, we would interpret this by saying the cash account has been overdrawn. We took out too much money. Our bank is going to start to penalize us for this. What if I give you beginning normal balance 100, ending abnormal balance of 100, and I tell you that cash payments during the year were 300? Could you figure out what the cash receipts were during the period? Of course you can. It takes a little bit of algebra, but most importantly, students do not do well on these types of problems on exams because they jumble up all of these numbers in a T account. You've got to practice sketching these things out, drawing them out, just so that way you don't miss any points on exam questions. Here, if you do the algebra, you'll figure out I need a $100 amount on the left-hand side. 200 is the total debits, 300 is the total credits. Therefore, this $100 credit balance, that makes sense. It is abnormal. We'll figure that out later, but more importantly, the account is the transactions and the account balance are correctly calculated. Make sure that you read carefully when working through problems. Working hastily means missed points. Specifically, now, we know how accounts change. We know how accounts reflect changes. What's the specific step-by-step we need to go through to record the effects of a transaction? First and foremost, We typically do not record transactions directly into T accounts. The first step we do is record a journal entry. Think about journals, like if you keep a journal, think about journals as a diary. Diaries tell us what happened and when. They're a chronological listing of events. Here's this date. Here's this date. This is what happened. Dear diary, dear diary. And we list all those things down from top to bottom, like we're telling a story of a business. That's useful because we can see at any point in time, we can see what happened on a particular day in a particular order of events. Doing this ensures that we capture all aspects of a transaction, and it also ensures that total debits equal total credits. When we look at journal entries, you see that it's an important sort of catch fail-safe when we record transactions in the journal to make sure that debits equal credits. When we record a journal entry and they don't equal, it means we need to stop, go back, reanalyze before we move on. After we record a journal entry, we then post the information to our ledger. Again, the ledger is the books. The books show the different balances of all the different accounts. The journal tells us what happened when. The accounts just simply tell us where do we stand at the end of the period. What's the end result? Where are we at? This process then repeats every time we have a transaction. Wash, rinse, repeat. So we're going to go through these examples over and over and over again throughout the class. So if this is still real, if you're still a little shaky about this, don't worry, we'll practice this a lot. Steps in the recording process. I would argue the most important thing to do first is to identify which accounts are affected in any particular transaction. So for instance, were any balance sheet accounts affected? Were any income statement accounts affected? One way to see this is, let's assume that in the transaction, supplies were received. Supplies tend to be a future economic benefit, a resource. They are assets. And if we receive them, then assets overall go up. It means, therefore, we need to debit that account. This is an important process because it gives you a chance to start to apply the rules. Applying the rules takes time. Sometimes you need to have a little cheat sheet off to the side to help remind you, but the more you practice this, the more you will see a pattern. The more you practice this, the better you will get. If, for instance, a transaction involved us paying cash, cash is an asset. Paying cash means that we reduce the asset. Therefore, the rule says we need to credit that account. You'll get used to this over time, but it's important that you practice it. When it comes to income statement accounts, just remember that revenues are almost always credited and expenses are almost always debited. So there's not a whole lot of debit and or credit. It's just pretty much just revenues are almost always credited, expenses almost always debited. When we kind of know where we're going, which accounts are being affected and how to record them, then we can go into the journal and record the transaction. Once we do that, we must then immediately after post the information to the specific accounts in the ledger. That updates all the balances to let us know where do we stand at the end of every transaction. So we will give ourselves real-time updates with regard to all of our asset accounts and liability accounts. So let's see this in action. First transaction, we got cash, we issued common stock. Cash is an asset. It increased, therefore cash requires a debit. Common stock is an equity account. That equity account increased, therefore common stock requires a credit. Again, these are the rules. You just need to remember them for right now. Eventually, they'll become second nature. In the journal, when we go into the journal, we want to first show the debits. Debit the accounts. In this case, whatever accounts were debited, show those in the first line. Go over and then under the debit column, plug in the amount, the raw amount. Do not use pluses or minuses, just plug in the raw amount. Then go down one line and indent, and then put in your credits. Debits go first, credits go last. Credits are indented. Go over to the credit column and input the raw number. No positives, no minuses, just the raw number. There is a little memo sometimes you see, and you may be required to input a memo on your homework. Sometimes you see this, sometimes you don't. It's just a memo to sort of provide more contextual information as to what happened. This says issued common stock, but this by itself, this memo entry is not sufficient for us. We need to know accounts and amounts because at the end of the day, all of this needs to be compiled and summarized into financial statements. Dear Diary, we issued common stock today. In accounting language, just like you're trying to learn a new language like French or Spanish, you need to take something that's in English to you and translate it into a different language. This journal entry you see here. This is the language. And over time, you'll be able to look at just this part and interpret that back into English. In other words, whenever you see, there'll be a point in time during this course, whenever you see a debit to cash, that you will know in English what that means is we got cash. Make sure after you record a journal entry that the sum of your debits equals the sum of your credits. It's a bit of a checkpoint, it's a fail-safe. If you do not have debits equal credits, you may have missed part of the transaction. That's step 2. The last part of recording this transaction requires us to post the information to the ledger. This is somewhat of a housekeeping task, but it's not trivial. It's very important. We go into the books, the ledger. We identify the accounts that were affected. Cash was affected. Identify cash. How was a cash affected in the transaction above? Oh, it was debited. Debit means left. So post this $50,000 on the left-hand side. Common stock was an account that was affected. It was credited 50,000. So go find the common stock account and post that information to the right-hand side. Even if you're not quite comfortable with what that means, doing this part mechanically still ensures that you've done the process correctly. Over time, you'll begin to note that, hey, common stock accounts that have any credits are actually increasing. Cash accounts, given that they're assets, if I see debits, it means that they're increasing. Debits must equal credits even when we post the information to the ledger accounts. Also, as a final step, and you don't have to do this, but I recommend you do this. We already did this in the previous class. Check the accounting equation when you're done. Take a step back and say, oh, assets went up by 50,000, equity went up. But try to avoid using pluses or minuses. Get used to looking at increases and decreases in terms of debits and credits. Remember, assets increase with debits, everything else increases with credits. Transaction number 2, we paid cash for land. What did we get? We got land. Land is an asset. That account increased. Therefore, the rule says to debit the land account. What did we give? We gave cash. Cash is an asset. That account decreased. The rule says credit that asset account. It takes a little while, but eventually you get there. When you record it, start first with the debits. Debit land, go over to the debit column and plug in the raw number, not plus or minus, just the raw number. Then go down to the next line, indent, credit, go over to the credit column and plug in the raw number. Yes, cash went down, cash decreased, but in accounting, we don't record that as a minus. We say cash is credited. There will come a point where you get used to interpreting this language, this accounting language, as interpret this in English as we paid cash. It's just a language. There's the memo entry to provide us a little bit more context. Third step, we take the information, go into the ledger, find the account, then post the effect to the proper side of the account. And we can just double check to make sure that the accounting equation balances. But again, try to avoid using pluses or minuses, start using debits and credits. Purchase office supplies on account. We got supplies, we gave a promise. We did not give cash. If you're not quite sure on how to record this, start with what you know best. If it makes sense that when we get supplies and asset account increases, we need a debit, that's a good starting point. You don't necessarily need to know or remember all the rules. Even if you can remember half of this, how to record this transaction, you're likely more like 90% of the way there. Go down into your journal and start to record what you know. Supplies being an asset and increasing is debited. So under the debit column, plug in the 3,700. Now, even if you don't know what the credit is, you know that you do need a credit. And you do need a credit, in this case, of 3,700. It's just a matter of figuring out or guessing what is the account that we need to credit. In the situation, when we have promises to pay, those are generally represented by liabilities. Unless there's more specific information, using accounts payable is fine. That's sort of a default liability account. We made a promise, we're going to have to pay some money later. We've incurred a liability, liabilities are increasing. The rule says credit those liability accounts that increase. That's how we know what we've done here makes sense. Even if we plug in the parts we know, generally speaking, we fill in the rest. When we fill in the rest, we're probably doing everything correctly. Next step, go to the ledger, find the individual accounts, and then post them accordingly. Supplies, debited, supplies, debited. Accounts payable, credited, accounts payable, credited. Left side equals right side, total debits equal credits. We performed services and we got cash. Figure out what you know first. Generally speaking, cash, this is the rule this is kind of how I learned debits and credits. I like cash. I don't know about you, but I like cash. When I get cash in accounting, that means I need to debit that cash account. So I started to learn that I like debits. Debits make me happy. The rule, of course, is that when we get cash, we need to debit the account. The offsetting part of the journal entry is the effort. That's the work we put in. In the case of effort or work, we call that service revenue. Revenues earned result in a credit to those accounts. I don't like credits because, well, in this case, I don't like to work. I like cash, but I have to work. Yeah, there's an emotional attachment to each one of these. That seems kind of ridiculous, but that's how I remembered it. So we're going to go ahead and start by debiting what? Cash in this case. Go over to the debit column, input the number, the raw number. What do we need to do next? Go down one line, indent, credit service revenue, go over to the credit column, input the 7,000. Next thing we do, we post the information to the ledger. Find the account. Cash is being debited, 7,000. The other part, service revenue, is being credited, 7,000. Debit 7,000 equals credit 7,000. We're doing it right. Again, try to think, instead of pluses and minuses, try to think in terms of debits and credits. It will save you so much frustration down the road if you start to learn this right now. We performed work. Again, what did I get in return? Well, I didn't get cash. I got a promise to receive cash later. A promise to receive is what we record in accounts receivable. Accounts receivable is an asset account. It's increasing. Therefore, the rule says we need to debit the account. I can go in and start to build my journal entry right there. Let me go a little step further. Effort results in revenue earned. Revenues are almost always credited. So plug in my debit, plug in my credit, put the amounts in the appropriate debit credit column. Then what do we do next? Post the information to the ledger. Accounts receivable was debited for 3,000. Accounts receivable, debit 3,000. Service revenue was credited 3,000. Service revenue, credit 3,000. Just make sure that what you input balances. The debit equals the credit in this case. This one was kind of tricky to some of you. When we paid cash for certain expenses, we know that cash decrease and therefore requires a credit. Even if you can only remember just that much, it's helpful because it gets you started with the journal entry that you need to record. Indent credit cash for the full amount that we paid, $2,700. For every credit, we need a debit. In this case, we need 3 debits. We need a debit rent expense, debit salaries expense, debit utilities expense. These are resources that we consume. Expenses represent the vapor trail. If we spent cash, what did we get? The expense accounts represent the vapor trail. It is some sort of residual documentation that says what we spent cash on. We don't like to see cash disappear from our checking account, but if it does go down, it's nice to know why cash went down. Expenses represent why cash went down in this case. So for every credit, we need a debit. Expenses are almost always debited. So go ahead and plug those in on the debit column. And then from there, go down and post the information. Debit rent expense, salary expense, utilities expense. Rent expense, salary expense, utilities expense. Don't forget to credit the cash. Some systems, if people are using a manual system, sometimes what you see are people making little check marks whenever they post things into the ledger, just so that way they keep track of the fact that that task has been done. It's somewhat of a tedious task, but it's a very important one. Transaction 7, paid cash on account. I don't know what happened there. That's okay, but I know that when I give cash, that asset account decreases, and therefore the account for cash requires a credit. I can start with that. In this case, when I pay down my debts, I'm getting debt relief. That's what paying on account means. So accounts payable, the liability account, is going down. I like debits. Debits make me happy. I like to pay off my debts. I don't like to pay cash, but I like to get out of debt. I like to get out of debt. Debt relief is good. Debit, accounts payable, 1,900. Credit, indent, credit cash, 1,900. Paid cash on account. Post it. Accounts payable, debit 1,900. Accounts payable, debit 1,900. Cash, credited 1,900. Cash, credited 1,900. Cash is starting to get pretty noisy. And one thing you might notice is that there's these little numbers next to the individual line items. These numbers specifically represent the transaction number above. So currently we're in transaction number 7. So down below what you see, this little 7 here represents is where in the journal that transaction appears. Typically what you see instead of these numbers is typically you see a date somewhere in the journal that we can go back to and find that specific transaction. There was no journal entry needed for transaction 8. That was one of the stockholders who did something to their personal house. We didn't need to do anything for the company's sake. But then there was the collected cash on the account. So people promised to pay us back money, and guess what? Now they actually are paying us back money. What do I go to first? I go with what I know. I like getting cash. This is a situation where I got cash. Cash is an asset that increased. We need to debit the cash accounts. It's just a rule, but maybe it helps you to remember that debits make me happy. What did I give in this case? Well, you don't get money for nothing. I had to give debt relief to my customers who paid me what they owed me. So in this case, assets, accounts receivable is decreasing. Therefore, I need a credit. The whole purpose of accounts receivable is just to be reminded of who owes us money. We don't want to keep an accounts receivable balance forever. We want to convert accounts receivable eventually into cash. Number 2, record the journal entry. Start with debits, Got cash, 1,000. Then go indent credit, accounts receivable, 1,000. Post the information into the ledger. Cash, debits make me happy. Credit, accounts receivable, there's the 1,000. What you might notice here is that when we do this, typically what we should do is update the balance in the accounts after every transaction. We're not doing that here, but if we did, we can see that the purpose of posting the journal entry to the ledger is to get an update as to what our balances are, what we own, what we owe, and what the residual amounts are in the equity accounts. In this case, by updating the accounts receivable account, I can see, oh, it's good that I collected 2,000. It's good that I collected some cash from my customers, but I can see that they still owe me 2,000. The journal, again, just as a reminder, the journal tells us, Dear Diary, this is what happened and when. The ledger records and updates the overall outstanding results, the balances. Sold land for cash. This one has a little bit of a typo, so you have to ask your forgiveness here. I got cash. Debits make me happy. It's a rule. What I got in return, scribble this out here. I got cash. What I gave was land. That's the typo there. Land is what I gave. That's an asset. It's decreasing. Therefore, it requires a credit. I don't like to give away my assets, but if it means I get cash, I guess that's all right. Debit, indent, credit. Cash goes first under the debit column, then land under the credit column. Does that make sense? Well, when you post it, I encourage you all to start thinking about whether or not it makes sense. If I debit cash, again, the language of accounting interprets that in English as I got cash. Does that make sense based on what we see up above in the analysis? That's what happened. Does it make sense for every debit we have to do a credit? Does it make sense that we credit the land account? You may not feel very comfortable about this, but just follow the rules and have a little faith that it will all work out. Credit land 22,000. Go down, find land, plug in 22,000. Then take a step back and ask yourself, does it make sense what I just did here? The end result is I have $18,000 of land left. Yes, that makes sense. I had 40,000. I only now, according to this, I only have 18,000 of land left. Based on the above, that makes sense because I actually sold land. Land should be going down. So in this case, the credit makes sense. Credits decrease asset accounts, debits increase asset accounts. This all takes time and practice, so go easy on yourself, but stay on top of it. Here's the last journal entry. Identify which accounts were affected and how I paid cash in the form of dividends. I'm paying cash. That makes me unhappy. Debits make me happy. More importantly, I like happy investors because investors will stay invested in my company and potentially will attract new investors. So I don't mind paying out cash if it means I get some sort of reward, something given, something received, something borrowed, something blue. That's a joke. Credit, debit. Plug the information down into the individual accounts. And then, holy cow, look at this cash cow. This is insane. That is an insane looking T account right there. Now, one of the reasons why we do a journal is because it's very difficult for us to look inside the cash account and figure out what the heck happened. Like you can see that these are all, because the cash is an asset account, these are reductions and these are additions. But I can't necessarily look at these line items and say, what happened? I have to go back into the ledger to see what the transaction was that caused these changes. The ledger provides different information than the journal, but they are used in conjunction with each other. Take a step back and look at the journal overall. This is all the work we did. It's important that we do this because that's a lot of work and it seems chaotic, and maybe it was just you just follow the rules. But here's the cool thing. You probably have done it right because when you sum up the debit and credit columns, you see that total debits equal total credits. It generally means that you've captured all the aspects of each transaction. So it's kind of a nice little checkpoint fail-safe device here. Then you can go into the ledger and take a step back and look at all the different accounts and their balances. If you add up all of the debit balances, they sum up to 61,800. If you sum up all of the credit balances, guess what? They all sum up to 61,800. They balance, they work, they equal each other. So one thing to keep in mind, by the way, is some people ask me, why doesn't these total debits equal these total debits and credits equal credits? And the reason why is because all of these, what you see up above are just raw inputs on the debit side. So all these numbers here you see on the debit side, that's what you see here, 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 here. The sum of all those things in yellow equals 1,334,400. Okay, but we don't show that in the ledger. What we show is the net effect to the individual accounts. So these balances right here, that 33,300, that's not just the debits, that's also the credits. So you have to kind of look at these things and say, well, you're going to get a different total balance. And when you add up all those different total balance, you're going to get net balances. And when you sum up the net balances, you're going to get total debits not equaling total credits. So trust that the system works. You don't need to have these total debits equaling these total credits. The bottom line, when all is said and done, the journal shows different information than the ledger. The journal is a dear diary. This is what happened and when. The ledger is a real-time update of all what we own, what we owe, and all the other equity accounts. They work in conjunction. You start with the journal, you post it to the ledger, wash, rinse, and repeat. But realize that each one has its own purpose. If I want, for instance, to know more about, let's see here, where did this revenue come from? It's difficult for me to understand the transaction. I know I earned revenue, but what did I get in this case? I can find that transaction, number 4, in the journal and see, oh, I performed services for cash. The journal gives me more information about the transactions. The ledger provides me information about what the account balances are and how they change. So overall, what we can do now is say these two documents are going to be useful to help us summarize what went on in the business. And that's what Learning Objective 2.5 is all about. So just be aware that you need to keep up with your reading, read before you come to class so that this stuff makes more sense. Make sure you get all the homework done on time. Please try to be proactive in getting your assignments done. You know by now these assignments are long, but they're meant to help reinforce the concepts and help prepare you for the exam, which is coming up in a week. If you have any questions, please let me know.